the replacement. You are meant to start on the replacement analysis. So I think we can go direct to that. Which question did you ask? So we go to the replacement analysis. Let us now check something brief on the replacement. We now go to the replacement analysis. So before we check more details on that, we can first note something brief about what we mean by replacement. So we can summarize that this involves, that's not the replacement analysis. This involves the process of replacing. It involves the process of replacing inefficient and old asset. The process of replacing inefficient and old asset, replacing inefficient and old asset with the new and more efficient asset, with the new and more efficient asset, with the new and more efficient assets, with the new and more efficient assets. Then we consider by noting that in this category, assets are classified into two categories. Assets are classified into two categories. The assets are classified into two categories. So A will be replacement of the assets, with unequal economic life. Replacement of the assets with unequal economic life. So A will be replacement of the assets with unequal economic life. Then B is replacement of assets with equal economic life. Replacement of the assets with equal economic life. The replacement of the assets with equal economic life. So we can start with replacement of assets with unequal economic life. We can start with the replacement of the assets with unequal economic life. Unequal economic life. So for that, we can summarize that there are two methods. There are two methods which can be used to evaluate these assets. There are two methods which can be used to evaluate these assets. There are two methods which can be used to evaluate these assets. A will be equivalent annual annuity method. So A will be equivalent annual annuity method. Equivalent annual annuity method. Equivalent annual annuity method. Then B will be replacement chain or the common life method. The replacement chain or simply the common life method. The replacement chain or the common life method. Replacement chain or the common life method. So let us start with equivalent annual annuity method. We start with the equivalent annual annuity method. The equivalent annual annuity method. Equivalent annual annuity method. So for the equivalent annual annuity method, we summarize that under this method, the following steps will be adopted. Under this method, the following steps will be adopted. Under this method, the following steps will be adopted. The following steps will be adopted. Number one is that compute the NPV of each project. Compute the NPV of each project over its initial economic life. Compute NPV of each project over its initial economic life. Compute NPV of each project over its initial economic life. Then step number two is that determine the annuity of the project. Determine the annuity of the project. Determine the annuity of the project, which has the same present value. Determine the annuity of the project, which has the same present value, which has the same present value as the NPV of the project, which has the same present value as the NPV of the project, which has the same present value as the NPV of the project, as the NPV of the project over its initial economic life. Over its initial economic life as follows. Over its initial economic life as follows. Over its initial economic life as follows. As follows. So to compute the present value for the annuity, to compute the present value for the annuity, we normally take the annuity and multiply by the present value interest factor for the annuity at R% in period N. So when you want to get the present value for the annuity, you simply take the annuity multiplied by the present value interest factor for the annuity at R% in period N. So we make annuity to be the subject. We make annuity to be the subject. So making the annuity to be the subject to be the same as present value for the annuity, then divide by present value interest factor for the annuity at R% in period N. So annuity will be equal to the present value of the annuity divided by the present. So we are simply making this to be the subject. To take that, divide by that value. But finally, it will be the same as NPV. We divide by the present value interest factor for the annuity at R% because we want to get the annuity of the project, whose present value of the annuity is the same as the NPV of the project. So we can now get a question in relation to that. We can now come up with a question in relation to that. So the first question I want us to use, is November 2019, question number 2, part A. We can check November 2019, question number 2, part A. November 2019, there is a question number 2, part A. November 2019, question number 2, part A. So that question 2, part A for November 2019. Question 2, part A for November 2019. It reads that Kanga Limited is considering the design of a new conveyor system. The design of a new conveyor system. The management must choose among the following 3 alternative course of action. The management must choose among the following 3 alternative course of action. So option 1, the firm could sell the design outright to another corporation with the payments over 2 years. Option 2, the firm could license the design to another manufacturer for a period of 5 years, which is likely to be the product life cycle of the conveyor system. Then option 3, the company could manufacture and market the system itself. This alternative would result in 6 years of the cash inflows. So cash flows associated with each alternative are shown below. So those alternatives are sell, license, also manufacture. Sell, license, and also manufacturer, where they gave you the initial investment. So sale is 400,000, license is 400,000, manufacturer is 900,000. So year 1, 2, 3, 4, 5, and 6, they gave you the cash flows for each. So the company has the cost of capital of 12%. So required advice can be limited on the best alternative based on number 1, net present value. That is the same as the step number 1 when you are using the equivalent annual annuity method. We have stated that when you are using that method, the first step, you calculate the net present value. So that Roman letter 1 is the same as the step number 1 of using that method. Then Roman letter 2, annualize NPV. That's the same as the annuity of the NPV. You are saying that annuity is given by NPV divided by the present value interest factor. So that's now the same as the step number 2. They want you to get the annuity value of that NPV. Then finally, you are meant to advance. So that method has now been divided into 2, step 1 and step 2. Then finally, you advise. So we start off with sell. We do each option separately. Then we can finally finalize what is required. So let us start with option 1. Option 1 is sell. We start off with option 1, where they are given us the sell option. We start off with option 1, which is the sell option. So we start off with option 1, which is simply sell. So the first step is the Roman letter 1, where you compute the NPV of the project. So the first step is simply NPV, which is given by present value for the cash inflows. We minus the present value for the cash outflow. So NPV will be equal to present value for the cash inflows. We minus present value for the cash outflows. So those cash flows are not the same. So what you do, you arrange it in this manner, where you will be having the year cash flows, then present value interest factor, 12% for each year, so that you get the present value like that. So we start off with year 1. So year 1, they were able to give you the 400,000. 400,000. So you simply confirm in the first table, check in the first table what is 12% in year 1. You check in the first table what should be 12% in year 1. So 12% in year 1 should be 0.1. 12% in year 1 should be 0.89, 0.829. So when we multiply that 400,000, we multiply the 400,000. So we multiply the 400 by 0.892. Should give us 357,160. Yeah, so that is now for year 1. We go to year 2. Year 2, they gave you 500,000. 500,000. So we also confirm What is 12% in year 2? It is 0.79. 0.7972. We also multiply the 500,000 by that figure so that we get the present value. So that one should give us around which figure? So 398,600. 398. So when we add, we now get the present value for the cash inflows. When you add them together, they will now be able to give us present value of the cash inflows, which is supposed to be around how much? 755. Yeah, so now from that figure, you less the present value of the cash outflows, which is now the initial cost of that sell option. It is also 400,000. So we minus the 400,000 at that point to get the NPV. So that NPV should be 355,760. So that is now the Roman letter 1. That will be Roman letter 1 of that sell option. So we need to go to Roman letter 2. Roman letter 2 is the same as the step number 2, where we get the annuity. So that is Roman letter 1. Roman letter 2, we need to get the annuity. So annuity of the NPV, you simply take NPV, divide by present value interest factor for the annuity, 12% in year 2, because it is for 2 years, like that. So you take 355,760, but you confirm in the second table. We confirm in the second table 12% in year 2. In the second table, what should be 12% in year 2? What should be 12% in year 2? So 12% in year 2 is the same as which year? 1.69. 1.6901. Yeah, so now calculate to give you the annuity for that. We now compute to get the annuity for that. So that's now Roman letter 2 for that option 1. That's now the Roman letter 2 for option 1. So after that, now we go to option 2. We now go to option 2. So option 2 is the license. So from there, let us now go to option 2, which is supposed to be license. We now go to option 2. So option 2 is supposed to be license. Option 2. It's meant to be license option. So option 2 is meant to be the license option. The license option. Option 2 is meant to be the license option. So we start again with the step number 1. Roman letter 1, we get the NPV. Roman letter 1, we simply compute the NPV. Roman letter 1, we simply compute the NPV. So NPV should be given by present value for the cash inflows. You minus the present value for the cash outflows. So this one has 4 years, not 4, but 5 years. So year 1 is 500,000. Year 2, it is 200,000. 200,000. Year 3, it is meant to be 160,000. Year 3 is 160,000. Year 4, it is 120,000. is 120,000. Then year 5, it is 80,000. Like that. Also confirm in the table, we already have year 1 and year 2. We only confirm year 3. Year 3 should be 0.7. 118. Also year 4 should be 0.6355. And finally year 5 should be what? 0.5674. So you multiply these figures by these figures from the table. You get them like that. Then you will add them together to give you present value for the cash inflows. You add them together to get the present value of the cash inflows. Then you less present value for the cash outflows. So present value for the cash outflows for this particular one, it was also 400,000. So you also subtract 400,000 to come up with the net present value. So compute, then you give me that figure for the NPV.
Total number and meaning 841 440. 837 430. Kwanza ni 446 450. 113 888. Pesa ndio mimi napata 159 480. 100 napata oh yeah, okay, ya pili 159 440. Ya tatu 113 888. Ya nne 76 260. 45 390. Total zinaongeza
So NPV, I can see 441 430. So NPV is 441, so 430. So we now also get the annuity from letter 2. So annuity should be given by NPV divided by present value interest factor for the annuity. That is 12% in year 5. That is 12% in year 5. So that the NPV is 441 for that. So you go to the second table, confirm 12% in year 5. You go to the second table, you confirm 12% in year 5. 3.6048. So that now should give you the annuity. Should now be able to give you the annuity. Someone else is saying NPV is 120. Annuity NPV. You are getting one what? 122 456. Went around 2. Yeah, so that is now for that project license. So finally, we go to project option manufacturer. We now go to option 3, which is meant to be manufacturer. So we go to option 3. Go to option 3. Go to option 3, which is meant to be manufacturer. It's meant to be manufacturer. It's meant to be manufacturer. So the first step again, you get the NPV. The first step again, get the NPV. First step again, we get NPV. So year 1 cash flows, these ones are 400. Year 2 cash flows, we have 500. Year 3, we have 400. Also 400. There is also 400. So we also factor in year 6, which is also 400. So year 6 in the table is 0.5. 5068.
66.
66. So now factor them in, get your present value of the cash inflows minus your present value for the cash outflows. So present value for the cash outflow for this one was 9,900. Then get your NPV. Once you get your NPV, also get the annuity. So annuity will be the NPV. Then you divide by present value interest factor for the annuity. So 12% in year 6.
哦，那可做组织的竞争之后，所以竞争之后就， You want to complete the old syllabus. This is the last sitting in the note of chance. Sijui kama lakini I don't think I can make it ningetaka kumaliza naye nikichukua zote sita tatu na too much for me.
No Wi-Fi is fine.
So what is the annuity? The annuity is 208, how much 2000? The annuity is 2,480. So we were meant to advise on the Roman letter 1. So using the NPV, which option has the highest NPV? Using NPV, which option has the highest? Option 3. So we comment that that's now the Roman letter 3 of the question. Roman letter 3, we comment that using NPV, select option 3. Using NPV, select option 3, i.e. manufacturer, i.e. manufacturer, i.e. manufacturer. Then The one for the annuity, which one has the highest? Option 1. Yeah, so now we also continue that while using the annuity, select option 1, i.e. the license. Select option 1, i.e. the license. So the sell, i.e. sell, since it has the highest annuity. So that is now for that Roman letter 3. So let us check another question. Let us now check another question. December 2014, question 1, part B. December 2014, question number 1, part B. December 2014, question number 1, part B. Now go to December 2014, question number 1, part B. December 2014, question number 1, part B. So that question for December 2014, question number 1, part B. So we can go through the question for December 2014, question number 1, part B. So that question 1, part B reads that Typical Limited is a manufacturing company. Which makes a wide range of products. It is a manufacturing company which makes a wide range of the products. One of these products require the use of the special machine. So the current policy of Typical Limited is to replace the machine more frequently due to the fact that its productivity declines and running costs increase as it gets older. Then they have also said that there is insufficient demand for the company's product manufactured using the machine to justify the purchase of a second machine, So Typical Limited sells the product made by the machine at Sh12 each, at which price it is able to sell up to 500,000 units per annum. Variable cost, excluding machine depreciation or running cost, amount to Sh4 per unit. They have given you the year of machine life, productive capacity, and the running cost. Then finally, they say that the cost of buying the machine is 6 million. Resale value of the machine will be 4 million for 1-year-old machine, 2.5 million for 2-year-old machine, 1 million for the 3-year-old machine, and 0 for the 4-year-old machine. The company will provide depreciation for its non-current assets using the straight line method. So all costs and revenue are paid or received in cash at the end of the year to which they relate, except the initial cost of the machine, which is paid immediately on the purchase. The company has an annual cost of capital of 10%. So now all costs required. Advise the directors of the company on whether to replace the machine every 1, 2, 3, or 4 years. They now want you to advise whether to replace the machine after every 1 year, 2 years, 3 years, or 4 years. So the starting point is for you to calculate the cash flows. The question did not give us the cash flows. Let us prepare the cash flow statement to get the cash flows to be discounted. Let us prepare the cash flow statement to get the cash flows to be discounted. Let us prepare the cash flow statement to get the cash flows to be discounted. Let us now prepare the cash flow statement. And now prepare the cash flow statement. Cash flow. Prepare the cash flow statement. So, and to see how to prepare the cash flow statement. So when it comes to the cash flow statement, prepare the cash flow statement. We need to come up with the cash flow statement. So there were basically 4 years. There is year 1, there is year 2, there is year 3, there is also year 4. Like that. So we start off with the sales revenue. We start off with the sales revenue. So sales revenue for year 1, you see the number of the units for year 1 are 500,000 units. So you take 500,000 units multiplied by the selling price per unit. Are you able to see 12? Yeah, so multiplied by 12 so that we get the amount for that. So it will be how much millions? So it will be 6 millions. So that means it is the same for year 2, because also year 2 there are 500,000 units. So this will also be the 6 millions. Then also the next one should be, now you take 400,000 also multiplied by what is the odds? So also this one should also be 4.8 millions. The next one, you or less the cost. So the cost, they are variable costs. Less variable costs. Less variable cost. So to get the variable cost, the question has given the variable cost per unit. You see, before the end of that same paragraph where there was 12, they said variable cost excluding machine depreciation on the running cost, and the running cost amount to how much per unit? 4. So you also do the same. You take 500,000 also multiplied by 4. 500,000 also multiplied by 4. So how much will it be for year 1? It's 2 millions. So this one should also be 2 millions like that. Then year 3, it should be how much? Because it is 400,000. So that one will be 1,600. Also, this one will be 1,600. And apart from that, there is also now the running cost. Running costs were given. We also less the running cost. We also minus the running costs. So running costs were given. The running costs, those ones were given. So year 1, it is given as 600,000, but there are 3 zeros at the top. We use 600. Year 2, it is 650,000. There are 3 zeros at the top. We use 650. There is also 750. There is also 900. So when you subtract them, you will now come up with, we shall now come up with the annual cash inflows. We get the annual cash inflows. We shall be able to come up with the annual cash inflows. Shall be able to come up with the annual cash inflows. So how much is it for year one? So 3,400. Then year two, that's 350. Then year three, 2450. Then finally year four, 23. So it is exactly 23. So there was no tax. There is no need of you depreciating the machine. The reason why we depreciate is to get the taxable income. So there is no need of you including depreciation because there is no tax. So given that tax is not given, don't bother continue to depreciate the machinery. Then again, it will not make sense because they have given you different resale value for each year. So now from there, we start with replace after every 1 year. Because they were asking you to replace it after every 1, 2, 3, or 4 years. So let us start with when you replace after every 1 year and see what will be the content. Now we check replace after every 1 year. We now start with replace after every 1 year. So let us now check when we replace after every 1 year. After every 1 year. Yes, after every 1 year. So when we replace after every 1 year, so there are 2 steps that we have done. You see, when you are doing the other question, where the first step is Npvp, the second step is the annuity. So we use that model. We are using the equivalent annual annuity method. So our first step, our step number 1, step 1, we calculate the Npvp. Npvp should be given by present value for the cash inflows. We minus the present value for the cash outflows. So we start with the present value for the cash inflows, whereby it will be the year, then cash flows, then present value interest factor, present value interest factor for the annuity, present value interest factor, not the annuity, sorry. The cost of capital has been given as what percent? 10% for each year, so that we get the present value. So that we come up with the present value. So we start off with year 1. We start off with year 1. So year 1, you had calculated the annual cash inflows. We got how much? So, but there is a resale value. There is a resale value for a 1 year because we are replacing it after every 1 year. So when you check through the question, What is the resale value for a 1 year project? Yeah, so you add the 4 millions. We add the 4 million, so that we get the total. So that total should be how much? It is 7,400, isn't it? So you check in the table 10% in year one. 10% in year one is the same as 0.9091. So 10% in year one in the table. So we multiply 7,400 by 0.9091. Sixty-seven, 27. So 67, 27 point what? 4. So that figure is now your present value for the cash inflows, because we are replacing after every 1 year. Yeah, so because you are replacing it at the end of year one, the figure you are getting there is now your present value for the cash inflows. Now you less present value for the cash outflows. So present value for the cash outflow is the initial cost of that machine. You see it is costing how much? 6 million. So when you minus, we now get our NPV. So NPV should be 727. 727.34, like that. So that is now our NPV. Once we get the NPV, we now get the annuity of that NPV. We now got the step number 2. So step 2, we get the annuity of that NPV. So it is NPV divided by present value interest factor. Present value interest factor for the annuity, 10% for 1 year. Like that. So that NPV should be 7. There are 3 zeros at the top, so that's the same as 340. Then now you divide by what is meant. So year one, it is still 0.9091 when you check in the separate table. So let me check some another pen.
I mean, I don't know if to do this in places.
So that is now when you replace after every 1 year. So how much is that annuity? 800. So 800. 366 like that. 066. So that is now what should be your NPV when we replace after every 1 year. So let us now check when we replace after every 2 years. We start again when we replace after every 2 years. Start afresh when we replace after every 2 years. So replace after every 2 years. Replace after every 2 years. So we start again when we replace after every 2 years. So the first step, we still compute the NPV. The first step, we still compute the NPV. So NPV should be equal to present value for the cash inflows with minus the present value for the cash outflows. So we start off, there is the year, then cash flows, then present value interest factor, So the cost of capital is 10% like that. Then we get the present value. So we start off with year 1. So year 1, it will not contain resale value. How much was our cash flows for year 1? 3,400. So there will be no resale value in year 1 because we are replacing after every 2 years. So we go to year 2. So year 2, how much was the cash flows for year 2? 33.50. But now we are replacing it at the end of year 2. What is the resale value of 2-year-old machine in the question? So you add 2.5 million. So when we add them, they should give us a total of 58.50. So year 1, this one is 0.9091. How about year 2? 0.8264 like that. So what is there for year 1? When we multiply, year 1 should be how much? This one is 30.
90.
90.94. Then the year 2 should be 48.34. So when you add them together, what should be our present value for the cash inflows? 79, 25.38. So now we compute the annuity. Step number 2, we calculate the annuity. So you less the present value for the cash outflow, which is simply the 6 millions. So that you now get the annuity. So that annuity should be 1925.38. So after that is now when you go to the step number 2. So step 2, we now compute the annuity. So annuity is supposed to be given by Npv divide by present value interest factor for the annuity. So 10% in year 2. So annuity there is 1923, 380. So we divide by, so what is 10% in year 2? 1.7355. So that now should give you the annuity when we replace after every 1 year. When we replace, after every 2 years. That will be now the annuity when we replace after every 2 years. When we replace after every 2 years. So let us now go to when we replace after every 3 years. Let us now also confirm when we replace after every 3 years. We now also check when we replace after every 3 years. So when we replace after every 3 years, now also confirm when we replace after every 3 years. So when we replace after every 3 years, we start again with the step number 1. We get the NPV, which will be given by present value for the cash inflows. We minus the present value for the cash outflows. So year 1 cash flows will remain 3,400. Year 2 cash flows will change to 3,350 because now there is no resale value. Now there will be no resale value in year 2. There will be no resale value in year 2. There will not be resale value in year 2. Now we also include year 3. We now also include year 3. So year 3 cash flows were how much? 2,450. Then we add the resale value for the 3-year-old machine. It is 1. So when you add, you get a total of 3,450. So confirm for me in the table. In year 3, 10% in year 3. 10% in year 3 should be which value? 0.7513. Like that. So we start, so year 1 has not changed, it's still 3090.94. Then year 2 should be which figure?
2768.
2768. 45. 44. So also confirm year 3. When you multiply 3,450 by 0.7513. 2591. So add them together to give you present value for the cash inflows. Add them together to give you the present value of the cash inflows. $84.51. 84.51.37. Then now let's present value for the cash outflows. So present value for the cash outflow was 6 million. So we minus the 6 millions so that we get NPV. So this one should be 2451.37. 37. So we get now the annuity for that. Our step number 2, sorry. Our step number 2, we get the annuity. So annuity should be equal to Npv divided by the present value interest factor for the annuity. So it is 10% for 3 years. 10% for 3 years. So Npv is 2451,370. There are 3 zeros at the top. So what is there in the table? 10% in year 3 for the annuity table. 2.4869. So that now will give you the annuity. When we replace after every 3 years. When we replace after every 3 years. When we replace after every 3 years. So after that, we now also check when we replace after every 4 years. We now also confirm when we replace after every 4 years. So when we replace after every 4 years, we repeat again the same concept. Repeat again the same concept. We start year 1, cash flows will not change. Year 2, cash flows will not change. Year 3 should now be 24.15. But year 4, cash flows for year 4 we calculated. They were coming to how much? So is there a resale value for a 4-year-old machine? Yeah, so this one will just be 2,300. Then also confirm in the table 10% in year 4. 0.68. So in that year 3, when you take 24.50 multiply 0.7513. The one for year 3. Year 3, year 4, year 3 we changed. 1840. 1840.69. How about now the one for year 4? 1570. So when you add, you should get now present value for the cash inflows. This one should give us around which year? 9217 point. 9270. Point what? 97. So now we less present value for the cash outflow. That was the initial cost of the project. Remember, it was 6 million. So that we get Npv. So Npv should be 3270.97. So now get the annuity for that. Our step number 2, we come up with the annuity. So annuity will be NPV divided by present value interest factor for the annuity. Cost of capital was 10%. 10% for 4 years. So you simply take 3,270,000. So what will be 10% in year 4? 3.1.
1699.
So that now will give you the annuity for that. Be able to give you the annuity for that portion. So we need now to compare all of them. Which one has the highest annuity? When we replace after every how many years? After every 3 years. After 3 years. So online you can confirm where is the annuity higher or maximum. Those who are online, I want you to confirm where is the annuity higher, which year? They are saying 2 years. Yeah, so someone else has given 3 years. Okay. But majority are giving 2 years. So or everyone else is giving 2 years, but someone had given 3 years. So reconfirm your values. So we now make a conclusion that the optimal replacement period is where the annuity is maximum. The optimal replacement period is where the annuity is maximum. Therefore, replace after every 2 years. Therefore, replace after every 2 years. You replace after every 2 years. So that's now what we can get from that question. So one more question still on that part. There is another question in the sitting of May 2017, question number 5, part B. Also check May 2017, question number 5, part B. We also now confirm May 2017, question number 5, part B. May 2017, question number 5, part B. So check May 2017, question number 5, part B. May 2017, question number 5, part B. So that question 5, part B for May 2017. The question reads that Juma Limited operates a machine. Juma Limited operates a machine which has the following maintenance costs, and the resale values over its 4-year life, and resale value over its 4-year life. So purchase price of the machine is 25 millions. The purchase price of the machine is 25 millions. So also you have been given year 1, 2, 3, 4, where they give you maintenance costs. There is also resale value at the end of the year. Then also the company's cost of capital is 10% now required. Advise the management of Juma Limited on how frequently the machine should be replaced. That's now the question. But now in this question, there are no cash inflows. So we shall approach the question from the cost side. We shall be getting the present value of the costs. So when we compute the annuity cost, we shall be picking the one with the lowest. So that question had no cash flows. Instead, they have given you maintenance cost and resale value. So we approach the question from the cost side. And when we are using the cost, we normally pick the one with the lowest. When we are using the cost, we normally pick the one with the lowest. So let us see what happens in that question. Let us now check what happens in that question. So we want to check, start with replace after every 1 year. So we start off with when we replace after every 1 year. We start off with when we replace after every 1 year. Or replace after every 1 year. Replace after 1 year. So we start with when you replace after every 1 year. So the starting point, step number 1, we simply get present value of the costs. So step 1, we get the present value of costs. So this question had no cash inflows. So we are not calculating Npv. We are getting the present value for the costs. So we start with the year, then costs, then present value interest factor, present value interest factor. So the cost of capital had been given as 10%. It is 10% for each year, so that we get the present value like that. So that we get the present value costs. So to get a present value cost, so that we get the present value costs. So when we are using the cost side, we start with year 0. When we are using the cost, we start off with year 0. Year 0 is the initial investment. We are looking at the question from the cost side. So when you check the purchase price of the machine, it was how much? So it is 25 million. The purchase price of the machine is 25 million. So we start with the cost side. So our year 0 is now to be factored. Year 0 has to be factored in. So year 0, it is already in present value terms. So that figure is normally already in present value terms. So it is just 1. So it will remain the same, 25 like that. So when you are using the cost, you start with the initial investment, which is normally incurred in year 0. Then after that, we go to year 1, because we are replacing it after every 1 year. So in year 1, the question gave you maintenance cost, which is 7.5 million. But now we minus the resale value. We are not adding because we have started with the cost. We minus the revenue. So resale value is 15 million. Resale value is 15 million. So we subtract. Then we see how much would be that value. So it will also be 7.5 that are negative. 7.5 million negative. So this one is 0.9091. So when you take negative 7,500 multiplied by 0.9091, it should be able to give us which figure? Negative 5. So when you add, but now it's a negative, it means you minus, we get the present value cost. We now get present value costs. Is it 18? Come on. 18,181.75. So that is now our present value costs. It is our present value cost. So after that, step number 1, you go to the step number 2, where now you get the annuity cost. We now get the annuity costs. So to get the annuity cost, you also take present value cost. Then we divide by present value interest factor for the annuity, 10% in year 1. So it will be 18, 181, 750. Divide by, so 10% in year 1 is 0.9091. So I'm including that because there are 3 zeros at the top. I'm writing it in full because there are 3 zeros at the top. So that is when you replace after every 1 year. That now gives us the present value for the annuity cost. When you replace after every 1 year. So now we go to, if we replace after every 2 years, we want now to check if we replace after every 2 years. So we start again when we replace after every 2 years. So we now check replace after every 2 years. Replace after every 2 years. So the first step, we also get present value of the costs. Our step number 1, we simply compute present value of the costs. So year 1, we still arrange it. Year 0 is not affected. Year 0 is not affected. So year 1, now there will be no resale value for year 1. It will simply be 7.5. That's now the maintenance cost. So year 0 is not affected. Year 1 you change, you remove the resale value in year 1. Because now we are replacing it after 2 years. We are now replacing it after 2 years. We are now replacing it after 2 years. So year 2, so there is that cost for year 2. So the cost for year 2, it is 11 million. 11 million. We minus the resale value for year 2, which is 10 million. So 11 minus 10 should give us 1 million. So confirm in the table, what is 0 point? What is 10% in year 2? 8264. So confirm for me for year 1. When you take 7,500, multiply by 0.9091. It will be which year? 68. So this one should just be 826.4.
Yes.
So when we add them together, they should give you present value costs. When we add them together, they should be able to give us present value costs. $32,644. So it is 32,644.65. So you also get the annuity for that, step number 2. Step 2, we calculate the annuity. So to get the annuity, you simply take present value costs. The present value cost. Now you divide by present value interest factor for the annuity. 10% for 2 years. So present value cost, it is 32, 644, 650. We divide by, so 2%, sorry, 10% in year 2. 1.7355. So that now will give us the annuity when we replace after every 2 years. That now will give us the annuity when we replace after every 2 years. When we replace after every 2 years. Let us now go to when we replace after every 3 years. Let us now check when we replace after every 3 years. So after every 3 years, we start afresh again. We start afresh again. We start with the step number 1. So step 1, we simply calculate present value of the costs. The step number 1, we simply calculate present value of the costs. So year 1 is not affected, just usually year 0. You just repeat the same what we have done. Year 1 is also not affected. Year 2, now there will be no resale value. Year 2, you change it to 11 millions. There is no resale value for year 2. So we now include year 3. Now factor in year 3. When it comes to year 3, we take 12,500. We subtract resale value to 7,500 so that we get the value for that. So how much will it be? So this one will be 5. Then also confirm in the table. What is 10% in year 3? 0.75. 1. So when you multiply 5,000 by 0.7513, that is 56.75. Just 5. How about the figure in year 2? The one for year 2, when you take 11,000 multiply 0.8264. 90. So add them together to give us the present value costs. So we add them together to give us the present value costs. So our total present value cost will be how much? 44. 665.15. So now you also get the annuity cost for that. We now also come up with the annuity cost. So to get the annuity cost, it will simply be given by the present value cost divided by present value interest factor for the annuity. That should be 10% for 3 years. So you take 44, 665, 1. So confirm in the table. $2.4869. 2.4869. So that now will give us the annuity cost. That should be able to give you the annuity cost. When you replace after every 3 years, when we replace after every 3 years. Nakuja ngapi? 17,960 point 171. So that's now when we replace after every 3 years. So finally, we got to replace after every 4 years. Finally, we got to replace after every 4 years. So finally, we check when you replace after every 4 years. So when we replace after every 4 years, we start again with the step number 1, where we need to come up with the present value costs. Where we need to come up with the present value costs. So arrangement is still the same. So this one will be 12,500 because there is no resale value in a 3-year-old match. So we are replacing it after every 4 years. So now in year 4, we include year 4, where you take 15, we subtract 2,500. So it will also give us 12 what? 2,500, like that. Then you also now confirm in the table what is 10% in year 4. 0.6830. Okay. So we now also multiply to come up with the values for that. So first confirm for me for year 3. When you take 12,500, multiply by 0.7513. $93.91.25. Also confirm for year 4. So year 4 should be which year? 8537. So when we add them together, we should get the present value, total present value cost. We get now the total present value costs. So it is coming to 58. So 58, 837. So finally you get the annuity cost. Our step number 2, you get the annuity cost. So to get your annuity cost, simply take present value costs. The present value cost we divide by present value interest factor for the annuity. 10% for 4 years. So present value cost is what we have as 58,837. So there are 3 zeros at the top. I put there 400. Then you confirm in the annuity table. What is 10% in year 4? 3.1699. So that's now we give you the annuity cost for that. To be able to give you the annuity cost. So those are now the only questions when it comes to replacement of the assets with the unequal economic life. So we need to advise. So on the advice, I want you to check the annuity costs. When you replace after every 1 year, after every 2 years, after every, so which one is the lowest? Yeah, because it is from the cost side, we pick the one with the lowest. So we now make a final decision by noting that the optimal replacement period, is where the annuity cost is minimum. The optimal replacement period is where the annuity cost is minimum. Therefore, replace after every 3 years. So that is now for the equivalent annual annuity method. So there is the second method we had identified in the notes, the replacement chain or the common life method. So you are dealing with the assets with the unequal economic life. You are dealing with assets with the unequal economic life. We said there were 2 methods. Number 1 was equivalent annual annuity method. You see that one? So we check now the second one, which is the replacement chain method or common life method. Replacement chain or the common life method. The replacement chain or simply the common life method. Replacement chain or simply the common life method. So I would like us to write something brief on that part. The replacement chain or the common life method. So we summarize that under this method, the economic life of all the projects, are made to be similar. The economic life of all the projects are made to be similar by carrying out continuous replacement. Then we continue by writing that the optimal replacement period is at the least common multiple. The optimal replacement period is at the least common multiple. So maybe I'll just give you a small illustration to demonstrate that. I want to give you a small illustration to demonstrate that method. So we can write that. So in an illustration, we summarize that. Consider the following 2 mutually exclusive projects. Consider the following 2 mutually exclusive projects. mutually exclusive projects. So we have project X. So we shall be having the projects. There is X and also project Y. There is project X and also project Y. Then also the initial cost. Initial cost, there is 100,000, each one of them. Also that one, 100,000. Then cost of capital, both of them, they are 10%. Both of them are 10%. Then economic life. So X is 2 years. X is 2 years. Y will be 3 years. Y should be 3 years. Then also annual cash inflows. So for the annual cash inflows, we start with year 1. So year 1, this one will be 60,500. The other one should be 66,000. Then there is also year 2. This one is still 60,500. But the other one should be 44,000. Then now year 3. So this one has no cash flows because it was awarded a 2-year project. But the other one should be 20,000. The other one should be 20,000. So now required. So required is that evaluate the two projects. Using the common life method or replacement chain method. Using the common life or replacement chain method. So we just So I want us to stop there. So we are meeting tomorrow our normal class. So we shall stop there. We are meeting tomorrow our normal class in the morning. So I will finish that part of the replacement. Then there was some notes I gave you. There's some notes I gave you for the financial derivatives. I hope you have those notes. Yeah, so when we finish that, we shall now go to that last item, which is the financial derivatives. So if we don't finish tomorrow, I will ask you, maybe we meet again on Wednesday, because I know by then you'll have finished, isn't it? So memorize hizo subjects zingine. Okay, so when we meet tomorrow, we can choose whether to meet again on Tuesday or on Wednesday, so that we conclude it. But we shall be able to finish. We shall be able to finish from my side. So let us stop there for now. For those who are going for advanced financial reporting and analysis, we can stop there for now. Yes, in your number 4. So the answer number 1 was adjusted NPV. Then to end up bond refunding, number 2. Then the other one was leasing. So now number 4 is the replacement position. So we shall have finished them at that point. So we can stop there for now. For the next class.